Welcome to Coffee Chats with Klaas. Hi, I'm CJ Klaas. Today I'm here with Eric Schwartz, Certified Financial Planner, to discuss a sweeping retirement bill that was passed in December of 2022, known as the Secure Act 2.0. Eric, I believe there were over 80 provisions in this bill related to retirement planning. What are some of the highlights?
Yeah, the new Secure Act 2.0 builds on the original Secure Act, which was passed in December of 2019, and further enhances the benefits of retirement accounts. All in all, this is a positive bill for savers, allowing for higher contributions and greater flexibility with retirement funds. However, this bill certainly adds to the already complex landscape for retirement plans. First major headline is the extending of the required minimum distribution age from 72 to 73 for those born between 1951 and 1959, and all the way up to age 75 for those born in 1960 or later. As you may recall, this was initially increased to age 72 with the passing of the original Secure Act from 70 and a half. As a reminder, RMDs apply to all pre-tax retirement accounts unless your funds are in an employer-sponsored retirement plan and you qualify for an exemption because you're still working. Furthermore, the penalty for missed RMDs has been reduced from 50% to 25%, and it can even be as low as 10% if you correct it within the correction window. If you'd like a refresher on this topic, please see our other video, Understanding RMDs and QCDs.
Eric, did the new bill make any changes to required minimum distributions for inherited accounts?
For the most part, no, but there is a new option for married couples if the younger spouse passes away first. So in that case, the surviving spouse can elect to use the deceased spouse's age when computing required minimum distributions, which would result in a lower RMD overall. If this applies to you, please seek advice from your financial planner or your accountant.
Were there any major changes to Roth accounts?
Yes, so there was a fix to an odd quirk in the law that required minimum distributions for Roth employer-sponsored plans, even though they're not taxable. So starting in 2024, Secure Act 2.0 eliminates RMDs for Roth funds held in qualified employer plans.
I heard there was some expanded flexibility for 529 college savings plans. Can you explain what flexibility may now be available?
Yes, the most common question we hear from clients who are contemplating funding a 529 college savings plan is, what happens if my child doesn't go to college? Generally, funds in 529 plans must be used for qualified educational expenses. But starting in 2024, the Secure Act 2.0 allows for a tax-free rollover from a 529 plan to a Roth IRA, subject to a lifetime maximum limit of $35,000. This is certainly a new and unique provision that gives families greater flexibility. If the child ends up with unused funds or simply enters the workforce and doesn't use any of the funds, moving the funds over to a Roth IRA can give the beneficiary an excellent start to their own retirement savings. But be aware, there are several stipulations to this provision. First, the 529 account must have been maintained for 15 years or longer. And the receiving Roth IRA must also be in the name of the beneficiary of the 529. Second, any contributions and earnings made within the last 5 years to the 529 plan are not eligible to be moved to the Roth IRA. These rollovers are subject to regular Roth IRA contribution limits, so rolling over $35,000 all in one tax year is not allowed. Lastly, and most notably, these rollovers are not subject to modified adjusted gross income limits like Roth contributions are.
It also sounds like individuals will be able to save more into their retirement plans. Is this correct?
Yes, there are a couple of enhancements here related to employer-sponsored retirement plans and to individual retirement accounts. First, as it relates to IRAs, catch-up contributions for individuals aged 50 and older will now be indexed for inflation starting in 2024. These catch-up contributions currently stand at $1,000 per year. For employer-sponsored retirement plans, there will be new enhanced catch-up contributions for individuals aged 60 to 63 starting in 2024. These individuals can contribute the greater of $10,000 or 150% of the regular catch-up contribution, which is currently $7,500. So as an example, 150% of $7,500 is $11,250. Which is greater than the $10,000. So a 62-year-old could make an additional $11,250 deferral into their retirement plan.
Are there any restrictions on this enhanced catch-up contribution for higher wage earners?
Yes, there's some additional complexity here. So again, starting in 2024, if your wages from the employer sponsoring the plan exceed $145,000, adjusted for inflation, then your catch-up contributions will have to be made as Roth contributions, thereby making them taxable in the year contributed. Now you may ask, what if my plan doesn't allow for Roth deferrals? Well, in that case, you're allowed to make these catch-up contributions on a pre-tax basis.
So Eric, what other enhancements were made to employer-sponsored retirement plans?
Yes, so one big one, soon if employers allow, employees will actually be able to elect to have any matching or non-elective contributions from their employee be added as Roth contributions to the plan. Historically, all employer contributions to retirement plans were contributed pre-tax. If the employee makes this election, the employer contributions will be taxable to the employee in the year contributed. Another interesting enhancement will help those who have student loans. So many times, individuals with student loans have to make the tough decision of paying down their debt or contributing enough to their retirement plans that they actually get the employer match. Fortunately, starting in 2024, employers will be able to amend their plans and allow matching employer contributions into the employee's retirement account based on their student loan repayments.
Lastly, were there any notable provisions that were not included in this bill?
Yes, there were a few things that didn't change. Qualified charitable distributions are still allowed to begin at age 70 and a half. There are also no new limitations on who can perform a Roth conversion or a backdoor Roth contribution. And finally, there was no further guidance on required minimum distributions for non-eligible designated beneficiaries who inherited a retirement account from a decedent who reached their required beginning date.
Thanks, Eric. I appreciate the thorough update on Secure Act 2.0. And thank you for participating in another episode of Coffee Chats with Klaas.